How you can become a multi-millionaire on just an average salary. Really? No, I'm not selling anything, just educating. I've met plenty of people who are property millionaires despite earning poor salaries and having a lack of apparent financial sophistication. Initially, I didn't get it. How is this possible? Have they just been lucky? Did they just take crazy risks? I didn't get it because our whole lives, investment experts have been feeding us stats not showing us the full picture. What are these stats? Well, before I started investing in equities, I was constantly reading statistics about how shares outperform property. It was almost like a financial truth. Property investment seemed dumb when compared to share investing in the long term. For example, looking on the internet at the thisismoney.co.uk website, it shows returns of shares versus returns of property over the period from 1985 to 2014. That's a 30-year period. In each case, £100,000 is invested, and the return in property comes to £502,000 over that time, and the return in shares comes to 1.5 million, and that's just the capital. The stats didn't lie. So it's case closed, forget property, invest in shares. And these stats are repeatable in a pattern across various countries. It's like a physical law. Except these figures are missing so much more of the story. Watch the following scenarios, each with another layer on, showing why you might be missing the big picture. Please note the following are just models. There are many positive and negative elements that have been omitted to expedite brevity and provide clarity. Before we discuss the scenario that has made people property millionaires, let's examine the most basic scenario. Scenario 1. Consider the following. Here is a simple choice. Would you put 100k in shares or property? Using the this is money return rates, after 30 years, we can see you'll make about 1 million more pounds in shares than in property. But this is not how it works usually, is it? Normally, people buy houses with a mortgage. So just in the previous example, you can take a mortgage out, and in this case, you have a deposit of less than 100k, an amount to pay at the end. The debt allows leverage. Based on a return on investment comparison and the data just presented, shares don't look as good as they did in scenario 1. Although your amount at risk is still 100k, your actual investment is 25k. Don't confuse amount at risk and investment. If you're still not convinced, for those who think the investment is 100k because the amount at risk is 100k, consider these 2 points. You may only have 25k to your name. In this scenario, how could you have invested 100k? Also, if the bank has invested 75k and you thought you had invested 100k, then there's a total of 175k invested into a 100k asset, which makes no sense. The conclusion of the scenario is adding debt to property can push up your return on investment to more than the return on shares. Normally, property owners are probably thinking of leverage as a way to get a bigger property, not increase return. Now, this is just a model, and there's a couple of holes in it, and you may think these property returns shown in the table are not comparable with the shares return because of at least 3 issues. Issue 1, the return has gone up, but it is at the price of increased default risk. Well, mortgage debt isn't like other debt. Default in property is not related to valuation, it's related to serviceability. That is, can you pay the interest? As long as you can pay the interest and follow the conditions of the mortgage, I'm not aware of an instance where the bank can foreclose. They're not making any more land, but they are making more people. The term of the mortgage can be 30 years plus, and inflation alone should guarantee a higher price at the end of the term. The chance of a property being worth less than the purchase price after 30 years does not bear out given recent history. Issue 2. You may think the options are still incomparable. What about the new introduced interest costs? Interest rates can be lower than rent, meaning you can make a profit on letting or saving yourself rental cost. So there is a new interest cost, but there's also a rent saving. But unlike rent, you'll get a house at the end of the term. Issue 3. Shouldn't the investment in shares be 25k too, because you can leverage shares via margin accounts? Yes, you can leverage shares via margin accounts, but if the valuation falls on a margin account, a broker will foreclose, but generally a bank can't. A mortgage term is usually set to 25 years or more. A margin account doesn't work that way. A property, you can borrow a higher percentage safely, as valuations don't move as fast as shares due to sticky wages and a market that's less liquid. You can go into negative equity safely with mortgages. And if you do get into trouble, your mortgage lender may work with you. It is unlikely your margin account manager will do that. So you can't borrow against stocks in the same way you can borrow against property. Debt is like fire, a dangerous servant and a fearful master. And hating the idea of debt, I initially wanted to buy a house with cash only. My hand was forced when interest rates dropped to near zero. It was plainly better to be a borrower than a saver in this environment. I learned a lot by taking out several mortgages over the years. It is unlikely I would ever buy a property without one in future. So don't discount this model if you were like me and you were looking at the downside of debt, because you are about to see the real power of leverage. Scenario 3. Moving closer to a more realistic comparison, we are now going to buy 4 properties for the same investment as the 100k in shares. This is possible because in the UK you can get a mortgage on investment property if you earn over 25k and meeting other conditions. We can now see how attractive this is over 30 years. This is our comparable with the shares. You can see we make 70k more profit than the shares for the same period. So taking it one step further with another comparison, this is the same as the previous scenario, except we now have 5 properties. This is possible because in the UK you can get buy-to-let properties with a deposit of 20%. The result is you can make the equivalent of over £2 million in profit. This is now comparable with the shares. We make about 400k more than shares for the same period. Except this is not quite the final story. Both the shares and the properties show a compound return on investment. But the real secret follows: compound leverage. You may have heard of compound interest, but what is compound leverage? Sounds crazy, but it's what businesses do all the time. Using the "this is money" annualized figures, remember we said house prices go up by 5.7% a year, after 5 years the property is worth £132,000. Follow closely. In year 5, each house now has equity of £52,000. Equity equals valuation take away debt. When your equity goes up, you can remortgage and take funds out for acquisition of new properties. You can now see this drawdown amount preserving the 20% deposit rule. When the amounts are drawn down, they reduce the amount already invested, and this amount is equity. The result is you're now making over double what shares would make. No way. Surely this is not possible. What about the banks? What about... There are a lot of whatabouts, but this scenario is possible. The model doesn't even cover rental income. Rents tend to go up with wage inflation. If rental yields after fees and expenses were 5%, you would have £150,000 a year income at the end of the period, plus the assets themselves. You've only seen a 5-year iteration. Imagine repeating it again after 5 more years, and so on. I think you get the picture. Remember, this is a simple model. There are a lot of complexities. Various fees are not shown, risks are not shown, you may have to manage the properties, but also the benefits are not shown, like being able to negotiate better and better with each property, or possibility of finding a profitable niche. You could also make money from refurbishments. In the name of expediency, not every possible scenario is covered. Disclaimer: this is not investment advice. This is only a model. I am not an investment advisor and will not be held liable for any of the ideas or errors shown. Good luck.